Hi there, and welcome to today's workshop on swing trading. My name's Tim Reset. I am a full-time trader. I blog over at eminimind.com. In this expert session, we'll cover in-depth three key topics surrounding breakout trades. We'll talk specifically about the setups that I use when swing trading, how to manage those positions, and how to find good stocks, ETFs, and markets to trade. So stick around as I walk you through this simple and easy to follow trading approach. Let's dive right in, shall we? The first thing I want to talk about is finding good markets to trade, and that starts with understanding the context of the market. So when I'm looking for swing trades, I'm essentially looking to buy strong stocks on pullbacks and weak stocks on bounces. So in this example, I've got a chart of Home Depot pulled up, and if I were to go to, say, a 5-year chart, we can see that the general trend is up on the 5-year time frame. So this is a strong stock. I don't do a ton of fundamental analysis. I stick primarily to the technical aspect. But just zooming out to a 5-minute chart is a really quick way to get a good read on whether or not this stock is relatively strong or relatively weak. Another thing you can do is compare the stock that you're trading with the broader market, the S&P. So if we type in SPY, we can get a read in the last 6 months. And then when we go over to that individual stock, Home Depot, we can see, okay, Home Depot is pretty much trending very similarly to the broader market, the S&P. If we go out to a 5-year chart, type in the S&P, we can see the same trend continues. Generally, those two are trending pretty much the same. So this stock is just about on balance with the market. It's trending in a similar fashion to the market. If we were to find a different stock that was trending downwards and the broader market was trending upwards, we could say that stock is relatively weak. Therefore, if the market has an up day, that weak stock might get lifted slightly. But when the market has a down day, we can expect that weak stock to really get hit hard. So when I'm looking at individual stocks, it starts with understanding the context. Where are we in relation to, the stock's overall highs and lows? And then what is the most recent trend look like? If we go through just with a 6-month chart and identify some of the swing lows and swing highs, can we identify ourselves in a nice strong uptrend or a strong downtrend or no trend? In this case, with Home Depot, we've got a swing low, a swing high, and a nice series of higher lows, higher highs, and then a higher low that was just put in last week. When I'm looking for a specific setup, what I like to do is find stocks that are trending with either higher highs and higher lows, a nice strong uptrend, or lower highs and lower lows, a strong downtrend. I like to stay away from stocks that are just kind of in the middle, moving sideways. And so let's talk about the specific setup that I use for both longs and shorts. What I like to do is identify the lowest bar, the lowest candle, if you will, in a pullback of a strong trending stock. So in this case, we've got Home Depot. The last couple of months, we've been nicely trending upwards, and then we started to get this little 3-day, 4-day pullback. And when we get that pullback, we can first identify, okay, well, the stock made a new high. And then after that, we started to get that pullback. And when we do, that's when I start looking for the market to break above the high of the lowest bar in the pullback. So as the market's moving down, I know that, the chances of this being a short-term move down are pretty high because, well, the stock just made a new 52-week high. It's trending very strongly. So as the market pulls back, I'm just waiting for it to break the previous day's high, the highest price in the lowest bar. So the high of the low bar. In this case, we have a break on the 20th of September, breaking above the high price of the day before that, the 19th. And that becomes the entry into the long. So waiting for price to pull back, first establishing a high, waiting for price to pull back, and then looking for a long above the high of the low bar in that pullback. So in this case, the 20th of September was the entry candle that gets us into the long trade, and that allows for us to get in, not chasing highs, but rather letting the market have a little bit of a breather. And this is a much lower risk entry point than if we were to just chase the market at highs. If we take a look at another example, that being Southwest Airlines, we can see the same thing is true in the opposite perspective. So we've got a 6-month chart here, daily chart. The market is trending lower, we can see, after a uh, couple of months now, it's trending lower. And so just by looking at the general swing highs and swing lows, we can see the market making a lower low, lower high, lower low, lower high. And in this downtrend of lower lows and lower highs, we can look for the market to get a bounce. And when it gets that bounce, what I'm doing is looking for the price to break the lowest price of the highest bar in the pullback, the low of the high bar. And so in this case, market's moving lower, and then we get a couple of days where we get a little bounce in the market. And when we do, I'm just waiting for that low price to break of the highest bar in the bounce. And that occurs on August 17th, breaking the previous day, August 16th's low. And that becomes the entry into the short. Now, whether it's a long or a short, the concept of looking for strong stocks that are trending nicely over a multiple years up near highs, or weak stocks that are either at all-time lows or new lows on the year, stocks that are making lower lows and lower highs. It all starts with understanding and determining the context of that specific chart. It doesn't do you any good to buy at the bottom of a swing low when the market is in the context of the downtrend. So if you were trying to just, buy each of these lows down here, well, you'd have a couple of days where it's a very short-lived rally, but there's really not the follow-through that you would get if you stick to buying strong stocks on pullbacks and selling weak stocks on rallies. So that brings us to managing the trade. Just looking at a couple of different charts, we can walk through some very concrete ways to manage the risk on the trade and then manage the trade when it starts going in our favor. So the first thing that I like to do, we'll stick with these two examples here. The first thing that I like to do is place my initial stop below either the most recent swing low or the current swing low. So just by looking at the chart, we can identify a little previous swing low, the current swing low if we were entering on the 20th of September, and just placing my stop just below that. And so if we just use 156 as a nice round number, it doesn't need to be anything too calculated. We're just looking for below the current swing low or a area that is near the price that we're looking to enter. So in this case, the high of the low bar was 158.32. So placing the stop around 156 gives us a very small risk for a very larger reward. The same thing can be done in the opposite perspective for a short. If we look for the bounce and we identify that low price of the high bar getting in on the 17th of August, we can just take our stop and put it just above the previous or the current swing high. And in this case, we've got a nice little swing high right around 56. So when I'm looking to place my stop, it's all based on, the market price. Where is the market level that may change a trader's opinion towards the market? Well, typically, if we break a swing low or a swing high, that's where that momentum is going to change. Now, when it comes to managing the position, there's two ways you can go about it. Two ways I like to go about it. A more aggressive approach, once the trade starts going in your favor, is to simply trail each candle's low every single day. Once the candle closes for that day and then the next candle starts to form, you can just put your stop up underneath that previous candle's low, the previous day's low. And then today's candle closes, and then tomorrow we open up, you can just move that stop underneath the previous candle's low and just keep doing that up underneath every single candle as every new day starts to form. And that gives you a pretty tight stop. And for longs, we're using the low underneath the low of the candle. And for a stock, it could just be 10 cents. For a short, you want to be placing your stop above the high of the candle. So on a breakdown, just placing your stop, trailing each candle's high on the way down. Now that's a more aggressive approach. Sometimes it'll only be 2 or 3 days of trending before you might get shaken out. And depending on the speed of that market and how much it's moving and how much the broader market is moving, you may want to use a tighter trail stop approach like that if the market's moving very quickly. Now, the second option that you have is to trail swings, and I'm going to go pull up a chart of Citigroup rather, to talk about this trail stop approach. Citigroup's trending nicely upwards. And so as it is moving upwards, you can just kind of visually look at the chart and see these pullbacks, see these breaks above the high of the low bar in the pullback. Market pulls back, breaks above the high of the low bar, gets another leg higher, pulls back, breaks above the high of that low bar with a stop below the swing low, and then continues on higher. And so what I like to do with trailing my stop a little bit more conservatively is to trail each swing low. So simply, if we were to get in here on the 18th of May, getting in on the 19th rather, the 18th would be that signal bar, the lowest bar in the pullback. If you get in above the high price of that low bar on the 19th, market starts making a new high. It pulls back. Once it makes another new high, we can take our stop from underneath the current swing low and move it up underneath the new swing low. Market makes a new high, it pulls back, makes another new high. We can grab that previous swing low where the stop is, move it up underneath the current swing low. Makes a new high, pulls back. Once it makes another new high, then we can move our stop once again. Then we go into this sideways pattern where the market is just kind of drifting sideways, our stop would still be underneath the previous swing low. And then once the market makes a new high, then we can continue to tighten our stop. So you need the market to make that new high to confirm the swing low. And the same thing would be true for shorts, just in the opposite direction. If you're getting in a short, the market makes a new swing low, bounces, makes another swing low, then you can just continue to trail your stop down each of the swing highs. And you can just use, 10, 20 cents above that high. If it's a stock that's in, the $50 range, $100 range, 10, 20 cents is probably more than enough. If it's a more expensive stock, you could use a little bit wider stop if you need to, maybe 40 or 50 cents. So that's the general approach to how I look for buying strong stocks in pullbacks and shorting weak stocks on bounces, looking for that break of the high to low bar or a break of the low of the high bar. Now, how do I come up with the stocks or find the stocks that will be good to trade? Well, let's dive right into that. So I like to use a program called FinViz. It's just a free online tool. And if we go to the screener, now you can do this on any stock screener. This one just happens to be the one I use. And let's go through my presets of things that I'm looking for to get a good list of stocks. So I do stocks that are over $10. I don't like to trade small penny stocks. And then I use a average volume that's over 200,000 shares. Then the last thing that you'll need to do is go over to the technical tab, and I just do a scan for stocks that made new highs. And so what I'll do is get this list. And today we can see that there's 137 stocks here that made new highs. And if we just take the first three, we can see that, yep, Abbott made a new high. And then, yep, Accenture made a new high. And so just by jotting all these stocks down on the list, just keeping a running total either in Excel or in a Word document. Excel is nice because you can just sort out duplicates very easily. Now you get a running list of stocks that are making 52-week highs on the year. Then I'll do the same thing, and I'll just do 52-week lows and pull up that will pull up a list of stocks. Notice that there's only 17 of these. And so if we pull up a couple on the top of the list, we can see that, yep, Dish Network is definitely in a downtrend, definitely making new lows. And so what I will do is then come back to these stocks in a couple of days. So let's go back to that Abbott example. Well, a few days ago or a few weeks ago, we also made a new high, and then Abbott pulled back and now has made another new high, and it's continued to do that. So this one's been on my radar, popping up on this 52-week high list over and over again. And so every time the market pulls back, that gives you an opportunity to get into this strong stock on a pullback. Same thing is true for the shorts, looking for stocks that are making 52-week lows, and then you can use those lows, wait a couple of days, check back with those stocks, and get into those stocks on bounces. Now, the last thing I want to talk about is how to manage your risk on the trade. So if you are using, we'll go to the Love example. If you're trading an individual stock, you might have a risk of, say, $200. I don't want to risk more than $200 per trade. And so if your entry on a specific stock is, in this case, we'll use $55 is the low of the highest bar in this bounce. And if we're going to use a stop of $56, well, what you want to do is take your entry minus your stop price. In this case, it's $1. We've got a $55 entry, a $56 stop, and take that dollar per share, divide that into your total dollar risk. In this example, we'll say $200 is the most I want to risk. So how many shares would you buy? You buy 200 shares. And that ensures that if the market goes all the way to your stop, your max risk will only be the $200. And so you can use that same formula for all the different stocks that you're looking at to determine, okay, I want to keep my risk the same across the board. I don't want to risk more than $200, but some stocks are going to be $150, some stocks are going to be $50, $20 versus $100. And so this is the way to adjust for the number of shares such that your risk stays controlled. And in trading, managing your risk is the most important aspect of the trade. You notice we talked about trailing your stop when the market goes in your favor. I like to be as hands-off as possible and try to stay in the trade as long as possible. And so when it's going in my favor, I just like to trail those swing lows and swing highs, allow the market to continue until there's a break in the swing low or a break in the swing high that signals a potential, longer term, bigger trend change. So you can use this same approach on different markets. You can use it on individual stocks, ETFs. If you're using options, just be aware of the expiration dates of those options and the time decay that's going to occur. So you can use the same fundamental approach looking at the underlying, but you could trade the option contract if you'd like. Sometimes there's a little bit more opportunity for shorter term moves with trading options and tying up less capital. I personally really enjoy swing trading the underlying stock just because there's very concrete levels and I can sometimes stay in a stock for 6 months or a year just because the market is making a new high and then pulling back, making a new high, pulling back, and I can just continue to trail my stop on the way up. And if we're in a longer term trend, whether it's an uptrend or a downtrend, or that individual stock is just in a really nice trend, you can really capitalize on those moves without making 1,000 trades every single day. So to learn more about my trading techniques, you can visit me over at emoneymind.com. Thanks for watching, and I hope you have a great day and best of luck in your trading.